Welcome, everyone, back to another Kingscrowd podcast. Now, maybe you're a founder, a potential issuer out there who's kind of wondering how to get the most out of their capital raise. Maybe you're an investor who is looking for the latest deals, the latest trends in the online private markets. Or maybe you're an industry professional, a marketing agency, a funding platform. This podcast is your weekly dose of everything you need to know about startup investing, raising capital online. And today I am joined by the wonderful Léa, our senior investment associate. Thank you for joining us, Léa. My name's Brian, your host, and we're going to be talking about something very recent in the news. That is that one of the companies that was a previous Kingscrowd top deal called Our Bond has gone public via a direct listing. So we're going to be breaking down everything you need to know, looking at the direct listing, Our Bond, and how they got there in that journey, what that means if you're an investor in them, and we'll be zooming out and taking a educational approach and look just at the situation of when a company goes public. How do you actually get access to your shares? How does all that work? So welcome, Léa. How are you doing today?
Thank you, Brian. Definitely doing great. Yeah, very, very exciting news to see that Our Bond listed on NASDAQ. And we'll I think talk a little bit in this podcast as well about the difference between IPO and direct listing, because I think it can be confusing for a lot of investors, but that's definitely for later. Before we dig in, maybe we should try to get our listeners a little reminder about what is Our Bond. So Our Bond is actually, its official name is TG17. We call it Our Bond, but I know they also brand themselves as Bond. So if you hear any of the three, it's the exact same company. And Our Bond is kind of a new type of personal security app. Just to explain, to kind of for people to get the idea, you got the Our Bond app. If you feel that you're threatened or you're in an emergency situation, it's kind of too early to call 911, you don't have a true emergency, but you're feeling unsure about something, what you can do is that you can go on the app, and in about 5 seconds, you're going to get a video call with a personal security agent. And that person will have the view through your cameras of what is going on. It's the person who's going to be listening to what is going on. So you can either talk to that person directly, explain your situation. If, let's say, you're being attacked or there's someone following you, you can have the person that is going to be on the phone and talking to the person that you feel threatened by, and the personal security agent can kind of try to get that person away, to tell them that they're being recorded, to tell them that someone is ready to assist you and call 911 if there's a need. Or in some cases, if you have like a medical emergency, or and you can't really talk or anything like that, well, then the person on the video can kind of assess what's going on and get you the help that you need. So what Our Bond is really offering is peace of mind, because most people are not going to use the app. I have it myself, and maybe I was just happy to have it on my phone, or if I was really working alone at night in the dark, I would just get my finger on it. So if something would happen, I would just need to release my finger. But it just, when you're walking around a big city at midnight, it's just nice to have it, but I never used it. And I don't hope or think I will ever have to use it. But if that was the case, people just have that safety in their pocket. Actually, to tell you how much it has been used, Our Bond got 1.4 million calls since its inception, 10,000 on them being a real emergency. So you have people testing the app, you have people who just think something's going on, they want a little bit of reassurance, and then they have the people, 10,000 people that actually were under threat, and Our Bond were able to help them. So that's a big success for the company. And the really business model of Our Bond is that it's not really B2C customers like you or I that are paying for it. It's mostly corporations. They have big clients like Apple, Disney, or Ralph Lauren. And what these corporations are telling to employees is, I care about you. I want to protect you. When you leave the store at night, when you go to the store early in the morning, I want you to be safe. Or if you're in the store alone or there's not a lot of people, I want you to be safe in case there's something that happens in that public place. And this is where Our Bond really got some resonance with the market. And this is how they were able to really grow their revenue. If I were to summarize the reasons why Kingscrowd Capital decided to make an investment back in mid-2024, I would say it's for three reasons. The first, the product is really differentiated. It's not just a safety button app, like you can find it on the App Store. It's really something more because you actually have light agents that are going to answer you in a couple of seconds. The second reason is that Auburn had a huge revenue growth. We can see it right now, 7.2 million revenue in 2023. That was a huge up from 2022. And the company was fairly priced at around $70 million. It was somewhere around 10x. We know there's a big software component. The company uses a little bit of AI. So it just made sense from a valuation perspective. And the third reason is maybe one of my favorite reasons why I really look for in a company that I like is because of the founder. So Darren Campbell already had two exits, two technologies company that he sold, one to IBM, the other one to HP, for a total of $900 million. And so what that usually signals to us is when the founder had so much previous success, there's a way way better odds that they will get another exit. And we have the result. In about a year and a half since we invested, our bond already listed on the NASDAQ. Brian, I'll get it back to you if you can show us a couple details about the deal.
Yeah, and I was just pulling up the chart. So they are ticker OBAI. Again, it's TG17 Inc. in case people get a little bit confused, right, for the legal name. But that's our bonds. That's the OB. Going back to the deal, I remember when we were looking at this and assessing it as an investment committee at Kingscrowd, and there was a couple of questions that came up, right? Because a lot of what they did and kind of their differentiation, as Léa mentioned, was being able to give employees or users, right, kind of that security where maybe you didn't need to call 911 in that instant, but giving you some of that peace of mind where being ready in case something were to happen, if you're in an uncomfortable situation, I think having someone that you could call to talk to, or even just having that button kind of ready to press, kind of put a lot of people at ease. So it's definitely solving a pain point, right? Because, Léa, I think you mentioned you've had the app, you've tried it out, and so you can definitely see the use case there. Some of the questions we had, though, right, was it differentiated enough, for example? So if Apple were to add this to every iPhone, what's kind of that competitive advantage that they had? And I think they showed that, they could continue selling to big partners like that to be able to get some good distribution through these people. And I think it was a lot of those partnerships and being able to offer that gave them a lot of their traction. If we take a look at the fundraising history as a reminder, so as Léa mentioned, we invested through the Kingscrowd Capital Fund when it was a 70 million valuation. The next round they actually did in September was at a $155 million valuation. And then they have now recently gone public. So again, if you just pull up the latest on Yahoo Finance, it shows their intraday market cap kind of based on the outstanding shares, and the share price is 235 million. So there's definitely been kind of the progress, and we've seen a lot in terms of how the company has moved and progressed from when we invested to where they are today. So Léa, I'll turn it back to you. Let's say I was an investor in this company. I personally wasn't, but they're now public. What happens next? Like, as an investor in their prior crowdfunding raise, what does this mean for me?
So the first thing you want to look at your emails, because on February 4th, Arbonne sent an email through Vistock, which is the transfer agent that they use to help you get access to help investors get access to their shares. And so on this email, you're going to have all of the details that you need to know. One of the things that is important to note, for example, is that your shares right now are basically in investor's name. Every investor had the share in their own name, and it's what we call direct registration system. And what needs to happen is that investors need to actually transfer these shares to their broker to be able to trade them on the stock market. There is a fee. It's a $120 fee. And I want to stop right here. So Brian, you can kind of tell us, what do you think about that fee? Because I know that you've invested in so many companies. You already had exits. You already had companies listing on the stock market. Do you feel like this is high? Could this have been better?
Short answer, yes. Right. Think about some of these investors. Let's take a look, actually. If we went back to their first raise, the minimum investment was $200. Let's say we were a minimum investor in this raise at $200. Let's just do simple math. Now, there's going to be things like dilution and some other things. Actually, Léa, I think you calculated some of the potential ROIs, right? So assuming we'd invested $200 at a 70 million valuation, at least as of the day of their direct listing, but do you have an idea of what that equivalent was based on their market cap at the time? Ballpark number?
Yes. So what happened is that on the first raise, the shares were investors, when we as Kingscrowd Capital, we bought the shares at 71 cents. There was a 3-for-1 reverse stock split recently. So if you bought, now one share is actually worth, sorry, 3 shares that you bought back in 2024 in the first raise became one share that are worth, that put virtually were worth $2.13. Now, when our bond listed on the NASDAQ, they're listed at $20. That's huge. If you go from $2.13 to $20, that's basically a 9.4x return. And if you invested, let's say in June 2024, and you were to have sold your shares at $20 right early February when the company just got listed on NASDAQ, investor would have realized a 282% return. So this is tremendous. And when I say 282, sorry, I mean annualized rate of return, because it's a 9.4x if I don't take the years into account. But as investors, we always want to know what is the return that we get per year. To give you kind of some comparison, in VC, we kind of expect to get somewhere around 25% on average on our fund annual rate of return. So already to get that 282% is huge. That means investors will have obviously to have accessed their shares, and they will have to have sold their share when it was $20. If you invested later on, let's say you invested at when the first one of our bond raise closed around May, then your return will be way higher, because I mean you will have made that type of return in even less than a year. Now, if you didn't sell your shares yet, or if you want to hold, but then you're going to get a different type of return. Or if you even sold your shares when the company when the share was trading the highest around $30+. I think it was around $38 around February 4th or 5th, right when it started trading, then you will have gotten an even bigger result. So that's just to give an idea of the return that investors can get. But because it's listed on the stock market, there's just so many things that need to happen for you to get that return. But even if investors were to sell right now, the return will still be huge. And if they want to hold and Welton bond becomes even bigger, then that's a very interesting story as well. Now, something that I want to note is that because it's a direct listing, and we'll talk about that later, bond is not issuing new shares yet. So right now it's just basically kind of a secondary type of trading where investors are being able to sell their shares to new investors that want to come in, or existing investors that want to get more shares.
Okay, awesome. That's the type of deep analysis that Kingscrowd brings, right? We're bringing this to you. I think most investors who invested in this, maybe you saw that email and you haven't even gotten to it yet, but this is why it's so critical. So I'll go back to your question, Léa. $120 V stock transfer. So the way this works, your shares were held with a transfer agent. That was V stock, I believe, for this transaction. So typically you'll get an email from them. You need to reach out to them. You can DRS your shares, which means essentially put in a request to get them transferred out to your broker. Once it's with your broker, maybe that's Schwab or Fidelity or whomever, you can then decide to sell those shares, keep them in account. That's basically how you would sell those on the open market, though. So let's go back to your question. $120 to transfer out. If you're that $200 investor who invested the minimum, let's assume the best possible 10x return, right? Like a 10x return, that 9.4, I'm using ballpark numbers here. You might have about, let's just say, a $2,000 worth of shares in them at the transfer agent right now. Now, $120 is still a lot. That's a significant portion of returns that's being paid for just a transfer fee. So now, that being said, right, this number could be smaller by the time you go to sell, and we'll talk about this in terms of just the dynamics of the IPOs and direct listings and how it works. But I think this is one of the issues in the industry that we still need to work through some more, in that a lot of these transfer agents, and this is nothing against V stock or anything else, like a lot of these were established long before the investment crowdfunding market existed. And I think the types of companies and investors that used it probably had much higher investment amounts, right? Like $10,000, $20,000 type investors. So if you're talking about $120 transfer fee and you're doing that not that often, that's a small percentage. That's almost kind of a rounding error in the noise. I have had other companies myself that have gone public, and then it was a $100 investment or a $200 investment, and it was going to be $85 for me to transfer the shares out. That's a 50% hit just being taken out in the fees. So there's a huge infrastructure problem that needs to be addressed here. I think if you're a issuer, if you are a founder who is considering going public, you need to be thinking about this ahead of time, because if you end up doing this and then your investors realize the fee is going to eat up half of their cost of investment, it's going to leave a bad taste in their mouth. It's just going to have a lot of bad, negative kind of connotations for them, which means more customer service emails, more complaints going to you. So really think about it, because I think there are some other ones out there where it's been free or where it's like $10 and it's much more affordable. And again, maybe vStock Transfer even has that. This is nothing in particular against vStock Transfer, but it's some of these dynamics around going public that the founders need to think about and that you as an investor need to be aware of. So going back to this real quick, the company, let's talk about the stock price, right? Because these are some of the dynamics also that I've seen played out time and time again when these companies do their public listings. And it's, again, nothing bad or inherently bad with, certain companies. It's kind of just the dynamics of how it works. So when this company first listed, think about the shares, as Léa mentioned. There were no new shares being issued. So all of the shares were essentially had to be sold by insiders or traded on the open market. Now, in addition, a lot of the insiders are locked up. So they're going to have additional transfer restrictions where they can't sell their shares. That means there's going to be very low float, or like very few actual shares that can trade hands, especially in those first few days before any investment crowdfunding investors have gotten a hold of them. What that means, and how I've come to look at this, is honestly, the share price in the first week or two is kind of meaningless. You might see it spike up to 200. You might see it drop down to 10 cents. It's whatever a few shares that are out there are willing to trade between the few people, right, that are, making some of these transactions. So you don't really know until, for example, a lot of the investment crowdfunding investors have gotten access to their shares until there's a lot more volume. So it's really hard to assess. And I think it's wrong to look at the price on IPO day. And let's say that you put in the transfer request, it might take 2 weeks for you to get access to your shares. If 2 weeks from now, this number is down 50% or down 30%, or maybe it's up 100%, you can't control a lot of that, because a lot of the share price that was kind of happening in those early days wasn't real to a sense, because just the artificially restricted number of shares that we're trading, right? Let's for example, let's just try and make this really concrete. Let's say our company, has 1,000 shares, but on day one, we only have 2 of those shares that are able to be traded, just kind of like using ballpark numbers. It's not representative of the whole company, right? Those shares, it's like much higher in demand. So you could have kind of artificial price inflation because there's very few people who actually are willing to sell that. And they might demand a high price. Now, once more of those shares become available, 300, 500 shares start trading, then you get a better feel where it's more of the company is actually actively out there being traded. So I have come to kind of accept that when these public listings, these IPOs, these SPACs happen, you need to wait a couple of weeks to sort of see where the price is actually going to settle. Now, that being said, as an investor, you need to think, do I want to move as fast as possible to get access to my shares to try and lock in a certain price? Or do you have more long-term confidence in the company to say, hey, I believe in what they're doing. Maybe I read their S1 or kind of their updates and their annual report since I invested. I actually still believe in the long term and I want to hold on. So that's a little bit of the dynamics around kind of how the IPOs, the direct listings, the SPACs work. But Léa, anything else to say there before we move on?
Maybe a quick distinction between what is an IPO versus what is a direct listing. So IPO, initial public offering, a company is going to basically issue new shares on the stock market. And the main goal for them is to be able to raise a lot of money. Now, the first downside is that it costs a lot of money for a company to do that. And so if you take a small company like OBAI that is still growing and needs its cash to be able to grow, it just would not make sense to spend that much money on an IPO. And also, if you're an investor in the company, you're probably going to have a lockup period of a couple of months before being to sell your shares in an IPO. The direct listing, what is happening here, only management and insiders really have some sort of a lockup period, but investors are able to trade their shares directly as soon as they are able to access them, and of course, if they want to. It's way cheaper for a company, but they are not able to sell new shares right now. It doesn't mean that Arbonne is not going to issue new shares at some point. It's probably what they're going to do. They need a lot of cash to be able to grow because it's a pretty it's a company with high capital expenditure. They need to be able to pay all of the security agent that they have. There's a pretty heavy workforce, and this is normal. This is how the business model works, and this is the type of company that is going to be successful once it's big, when it has a lot of customers, a lot of revenues, and once it can really achieve economies of scale. And so right now, Arbonne kind of took the cheaper route, which means that investors have actually a little bit more freedom on when they want to trade as soon as they can access the shares. And it's going to be way cheaper for Arbonne. And so just better for any investor when they will be able to issue new shares because they can just take their time. And so it just makes sense for a smaller company to list that way. And a good example of a company that did that, for example, is Spotify. They had a direct listing and they just did not need money right now. They wanted to provide liquidity, and then were able to, if they would have wanted to, could issue new shares at just with way less fees.
Awesome. Yeah, I think Slack also was a direct listing back in 2019. There's been more and more direct listings, and again, as Léa mentioned, there's pros and cons where it's cheaper, or for the company, like it's perhaps more affordable. You're not paying as many fees to investment bankers, but you're not raising. It's not a primary offering, right? When you might hear us say primary versus secondary. Primary means companies issuing shares. The funds that you used or brought in to sell those shares then go to the company and kind of go into the coffers and can help build it, versus secondary shares, you're buying them off someone who's already a shareholder. So the money exchange is happening between you, the new investor, and the existing investor or insider. It's not necessarily going to the company itself. So that's a good breakdown of kind of primary versus secondary markets. Anything else, Léa, in terms of just, I mean, there's been a lot going on with this. Anything else investors should know, or founders? What about, from the founder side, is there anything based on this you think that they should also be thinking about?
I think that if you're a founder, it's definitely great to provide liquidity to your investors. Now I feel like based on the regulations, obviously, you have to still comply to these, but the more you can inform your investors and the more you can make it easy for them is going to be great, not only for the reputation of your company, but also for the whole equity crowdfunding industry. And I know that Arbonne, for example, as soon as they were about to, they published an update on WeFounder. So if people just kind of missed the announcement from Vstock, which going to be possible because you may not be expecting to get that email in your inbox, at least they got the update from WeFounder. So that's a really pretty positive sign in this case.
Yeah. One other note on that, that's an important reason. Make sure you're keeping your address updated, like on the various platforms, because sometimes these transfer agents will send you snail mail for your accounts. I've had that from ComputerShare and from some other ones. And if your address is out of date, you're not going to get that account certificate that's telling you that you have shares with a certain company. So make sure you're keeping your company, your personal info up to date on these platforms. And in addition to that, yeah, just on the communication front, couldn't agree. We totally understand, and we know that there has to be a quiet period, right? Kind of before certain, after certain filings or before certain offerings, that sort of thing. So sometimes companies are legally restricted by the SEC and other regulations in terms of what they can say before going public. But you need to be in communication with your investors, because if the first time they hear about it is through the news article or something else, or through a friend, months after it happened, they're not going to be very happy, and that's never a good outcome. Awesome. Well, let's wrap up that IPO discussion, the direct listing, public listing discussion. Thank you, Léa, for your coverage today. Just as a reminder as well, we want to make another plug. Remember that Kingscrowd, our own company, has our own offering open on startengine.com. So you can head over to Start Engine, check out the Kingscrowd offering. And while you were there, we are doing some different webinars that are going to be going into details about our business and our product roadmap. So we actually have a webinar tomorrow that you can sign up for on February 10th. If that has already happened, if you're watching this after February 10th, I have an upcoming product webinar that will be going over the product roadmap. I'll be sitting down with our CEO and founder, Chris Lustrino. That's going to be next week on Tuesday, February 17th at 2 p.m. Eastern. So we're going to be going inside Kingscrowd's product roadmap. Join me, CTO Brian and Léa at Kingscrowd, and I'll be sitting down with Chris Lustrino. Thank you, everyone. As always, feel free to drop any comments. We'll be dropping the registration link for that into the chat below this. So if you want to sign up, you'll be able to find that registration link. Let us know if there's any other topics you want us to cover, and we will continue to bring you the great data-driven insights every week in the online private markets. So whether you're a founder, an investor, or another industry professional, this is your go-to dose of the weekly online private markets. Thank you, and see you back here next time.